Morning, Bob. Morning, Tanya.
Hey, Jonathan, you there?
Yeah, Tanya gave me the sign, so I was being quiet.
Oh, well, I have a mute symbol on Tanya's screen, and I had one on yours. Is she muted?
She is, yeah.
So I don't have to do anything?
No.
Okay. Laptop was really slow on startup.
Really?
Yeah. So just be prepared if I get
disconnected.
Well, or kind of slow, or I cut out or anything. Seems okay, but.
How are you this morning?
Good. Good. Nice day.
Hey, everybody. Sorry about
It's okay. We're recording all the pre-conversation too.
Did it recording yet? It has started recording pre-conversation. I can cut it out if need be.
Okay, fair enough.
Yes. Sorry, it's one of these days I've been up going back to back to back since like 8 a.m. So.
Oh, one of them, eh? Yeah, I've been doing pretty much the same today.
Yes, yes. All right. And then you have a lunch with our mutual client today. And as soon as we're done this, I'll be shooting off an email that everything is done. I've got like 2 things just to go in and double check for you. It should all be done. But anyway, we're right at 10 on the button.
Perfect.
So let's just get started. So welcome everybody to Enhancing the Accountant Bookkeeper Connection series. That is myself, Tanya Hiltz, founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. There's a little bit about me. I'm not going to read through all of it because it just gets tiring reading through all of it. A couple of things just to point out that for those of you who don't know, our Bookkeepers Bootcamp program did qualify for IPBC continuing education credits in 2018, which was a pretty big deal, which is why that's kind of at the top of the accolades list. And then of course, we were Intuit's Global Firm of the Future for 2018 and Practice Ignition's Top 50 Women in Accounting for 2018. And I will just leave all the rest because, yes, you can read yourself. Okay. Little bit about me. Again, anybody who knows me knows that, I'm very involved with my family. My daughter is in a lot of those pictures and my husband is only in one. My daughter and I like doing unique experiences, which are most of those pictures of meeting our favorite actors or some of our favorite bands. There's, of course, little Rosie in the bottom, who is our office manager, and, of course, my four-legged fur baby. And, of course, my daughter and I together are learning American Sign Language, which is a very beautiful language to learn. And so just to confirm, this webinar does qualify for CE credits. I know the past couple, we didn't necessarily get approval until afterwards. There was a bit of a delay with the approval process. I've already received the approval through for this, so this one does absolutely qualify. There will be 2 polls that must be answered in order to qualify for the credits. and the recording of the webinar will be emailed within 2 days, and the certificates for the CE credits will be emailed within the next 2 weeks. Just a little bit about KATA accounting. So I've been collaborating with Jonathan and Bob for a number of years. We have got multiple mutual clients, I think probably gearing up towards the double digits at this point, definitely more with anybody else, because they're amazing to work with. They work in QBO, they pay attention to detail, huge with customer service and client communication, and all that is very important to myself and my clients as well. So if somebody comes to me that does not have an accountant they're working with, this is actually our first, the first name that we give them is KATA Accounting, because they've got a great team there. So that is it for me. I will now pass this over to Jonathan and Bob to take over.
All right, I'm going to share the screen.
Oh, and you know what? Apparently the recording will not include the audio, but everybody can hopefully hear me. So I'm just going to try to fix this. Okay, that message is gone. So hopefully the recording will now show the audio.
Okay.
Okay.
So everyone should be able to see the title page. Today we're going to be talking about the buy versus lease decision. Get into a quick spiel about who we are. I'd love it if you follow me at jcartercpa on Twitter. We're also on Facebook, both company and individually, as well as LinkedIn. I do use Instagram, but I'm just getting used to it. Not too involved there yet. So I'm considered a thought leader in accounting and technology. I was a member of the inaugural Accountants Council, a lead ProAdvisor, Intuit All-Star, and winner of the 2018 Inspire Accountant Award. We are known collaborators. We want the industry to get better across the board. When I first started working in this industry, it was absolutely shocking, some of the things it was a big affiliate. I'm also a member of the JCCC, Japanese Canadian Cultural Centers Board. I was brought in for my QuickBooks expertise when they switched from Simply to QuickBooks Desktop. I'm also an avid fisherman, MTG, and poker player. So, Bob, how about you want to talk about yourself for a minute?
Sure. Good morning. Good morning, everyone. It's great to be here with you and sharing some hopefully useful information. I'm Bob Hamilton. I laid out my background here. It includes a stint at the University of Waterloo studying mathematics, then working for a CA firm, it was known in those days. Then I moved into industry and worked in financial planning, doing future multi-year projections, planning models, and that sort of thing. Because I moved around a bit, I had experience in a number of interesting and key industries in Canada: oil and gas, real estate, insurance. So I was fortunate to be able to gain that experience. Some of the companies I've worked with, and I was recently, very proud to say, awarded a Lifetime CPA award. Currently living in Georgetown with my wife and our 4 fur babies. And some of my hobbies when I have time are woodworking, like to travel. I've recently started to learn more about automobiles, and that's a great way to relax and kind of, but sometimes it can be stressful too. And I like doing equity research, stock market analysis, and that type of thing. Happy to be here with you today.
So the bulk of what we're talking about in this series is management accounting. I apologize if I'm looking off to the side. I have multiple monitors. So the simple definition is providing financial, non-financial decision-making information to management. Today's example is probably one of the most common and one of the most useful. Quite often decisions are made without any real thought to the future or considerations of different opportunities. And especially when you're working with startups and entrepreneurs, this decision can be very important. It can really help a company succeed or sink them really fast when the cash is tight. I was originally trained as a management accountant, and management accounting is the profession that partners with management decision making. So a lot of planning, performance management, KPIs, monitoring, trending, examining drivers, budgeting, forecasting, helping make a decision as to what best fits with the organization's strategy, things like that. So essentially, outsiders use financial reporting, insiders and management use management reporting. Sometimes it's required by maybe loan covenants or by statute. For instance, certain organizations must have an audit or a review if they reach a certain size. And whereas management accounting is usually at the discretion of management and is quite often overlooked because of that. If you have somebody who's not very involved in their numbers, they're probably doing little to no management accounting examination. The management accounting can go from an individual right through up to an entire division. There's many different ways of looking at it, whereas financial reporting is just the big picture, just the whole company. And again, the focus on management accounting is the future, whereas financial reporting is the past. A lot of small businesses out there are just struggling to get by and literally have no idea how they're doing until 3 to 6 months after their year end, when their taxes get done. And it makes it more difficult to manage the company day to day if you don't know what's going on. So I would highly recommend considering speaking to your clients about management accounting. So the objective of these webinars is to introduce tools and opportunities where you can approach your client, because they're not going to come to you, to help them make plans for the future, help them really grow and develop their business. This is really what leads to becoming that trusted advisor, is when you're not just looking at the past, you're not just processing numbers, but you're actually providing some insight into how the company's doing, areas where management needs to pay attention, things along those lines. So as you can see, there's a slew of potential management accounting topics, and this is not even all of them. You can see that we're taking a break next month and for August. So there'll be a couple months off, but then we'll be getting into risk profiling. And this is something that I'm very excited to talk about, because this is something that I think a lot of individuals and companies don't even realize their current risk profile. Today, we're going to be talking about the buy versus lease analysis. This is a great example of how you can add value. So Bob, did you want to go over this slide, or should we just skip it?
Well, I think we can skip it. The only thing we can maybe say is that the left side of this chart is focused on financial accounting, and the right side is focused on management accounting. So we'll let you go through these topics and read the detail on your own, but certainly the buy versus lease decision lands firmly over on the right side. You can see the last bullet point there, make versus buy, and that's very similar to the buy versus lease analysis. So we're on the right-hand side of this chart.
So time for the first poll. How many of your clients have acquired, either bought or leased, major business assets in the last year? I'd be curious as a follow-up to how many of your clients asked you for input before they made this decision too.
You're giving away the next survey question, Jonathan.
Oh, no.
All right, so we three more people left to one more person left to that's on the call left to this. So we'll give it 15 more seconds or so. Oh, perfect. 11 and 11, 100% voting. So we'll just end the polling here. And I'm sharing the results right now if anybody wants to take a look. Hopefully you guys can see it on the screen.
Whoa. I would have expected a number of zeros. So a lot of businesses are out there making acquisitions,
Major
spending their
purchase.
money.
And I know I don't get a chance to vote, but we're 2 to 3. I can't remember if it was 2 or 3, but yeah, so we've definitely had some this year as well.
Yeah.
I'm pretty sure we're over 3.
Yeah.
Well, mind you, a lot of that is from tax work where we don't get to speak with the client on a regular basis.
Right.
So did your clients involve you, Tanya?
Yes.
Yeah.
Well, not all of them. Some of them do. Some of them don't. I just all of a sudden see $30,000 go to their bank account and go, hey, what's this for? We don't have a receipt. Oh, it's the new vehicle. And most of it's vehicles. We've got one client that bought 2 vehicles this year. But yeah, and with us, most of it's vehicles, for sure.
So let's have a look at the advantages of leasing. It's less upfront expense. It tends to be a higher monthly or regular recurring payment than a purchase or financed purchase, but it's less money upfront. Just think about buying a house. If you're rent a house, you got first and last, and then you're paying your monthly rent. Whereas if you buy the house, you have to put in significantly more than first and last to make the purchase. Leases are 100% deductible, whereas purchases, the majority of it ends up on the balance sheet, not on the P&L. So the interest is the only part that is typically deductible.
And then, of course, capital cost allowance as you write off the asset off the balance sheet.
Yeah. And in some cases, with real estate in particular and property rentals, perhaps that's a decision that you choose not to do because it could increase your capital gains when you do sell. There's more flexibility to renew the assets regularly and get like new vehicles or new tools, things like that, by doing the lease. And sometimes you don't have to pay for the maintenance. Depends on warranties and the lease agreement and things like that, but quite often you don't have to pay for maintenance. So big disadvantages, there's no investment potential. So if you're leasing a property, you have no possibility of taking part in the appreciation, the value of the property. Most large assets that are purchased are depreciating and are negative cash flow assets. Those are assets that cost money. They will help you generate money, but they won't appreciate in value. So for instance, the little cat here, I don't even think this is a cat. I think this is a different brand, but these kind of things, they're going to lose value over time, and you're never going to sell them at a big profit. I mean, you might sell them at higher than book value, but that's about it. You have higher monthly payments that was discussed before, limited control of the property, and there's a lack of flexibility. You're locked into a lease term. So those are some of the disadvantages.
And it's not really laid out here in the disadvantages, but over the full term of the lease, if you look at your total leasing costs versus purchasing, the total leasing costs, because the lease company needs to build in a profit margin, so the total cost will be greater than if you just buy it up front. And even on a discounted cash flow basis, as we'll see in the examples, over time, leasing becomes more expensive than purchasing.
Oh, I'm going too fast here. A bit of a lag, I guess. So some of the advantages of buying, you control the asset. You can choose when to sell it, how to use it, how to alter it, things like that. If there are capital gains in the realm of real estate, especially, it will accrue to the owner of the asset. The flexible timing. What did you mean by that, Bob?
When you lease for a fixed term. So a 5-year lease. So if for some reason you stop using that asset after 3 years, you're still locked into the lease payments. So if you own it, you can choose to sell it at any point in time. Or if there's new technology and you're stuck with an antiquated equipment, you still are locked into the lease. You lose your ability to choose the timing as to when you move things in and out.
Okay. Of course, there are tax incentives for different categories. In addition to the tax incentives, there might be financing incentives or financing possibilities. For instance, I know that BDC does a lot of funding of commercial property loans, mortgages, that are of course secured against the property, but would otherwise allow entrepreneurs to purchase properties that would be far beyond the realm of going through a traditional bank. Similar for Farm Credit Canada, purchasing a farming property. It's relatively straightforward most of the time to purchase. It's a one and done kind of situation. There's no ongoing relationship. And quite often the asset is used as loan collateral, resulting in a lower interest rate. Disadvantages, we talked about earlier, the high initial cash outlay. You could end up with outdated technology, and you're responsible if something breaks. So if you purchase that property and then there's a fire, you better be insured. So we'll talk more about that in risk profiling in September. But so Bob, do you want to talk about this slide, the capital versus operating lease?
Sure. One of the main drivers in needing to distinguish between a capital lease versus an operating lease is that some companies and some lease companies saw that there were tax advantages to leasing equipment because all your outflow, your lease payments, are tax deductible. So lease companies and companies got together and they said, I really want to buy this airplane, but I want the tax advantages of leasing. If I have to take capital cost allowance on my tax returns, I'm not getting as good a tax bang as I would if it were leased. So they started to disguise a purchase, companies and lease companies. The lease company said, okay, we'll give you something and call it a lease, and we'll draw up the paperwork and make it look like a lease. You will pay us for 5 or 10 years, and then we'll sell you the equipment for $1 at the end of the lease term. So you'll get to write off basically all your purchase costs rather than waiting for that slow capital cost allowance to come through. So the tax guys got wind of this and figured out what was going on. So they said, we're not going to allow you to disguise what is really a purchase as a lease anymore. Even if you write it up as a lease and you pay the same amount every month or every year, we're going to force you to capitalize that asset and then take capital cost allowance on it. So, and there's all kinds of, there can be slightly complicated accounting process to do that. So what you're going to do is if you buy the plane and it's it's papered as a lease, you're going to have to put the full estimated purchase costs on the balance sheet And sometimes that is just the net present value of the future stream of cash flows. And you're going to put a corresponding liability on the other side. So you basically present value your lease and then write it off over the term of the lease rather than just plunking in the lease payments every year. So the revenue guys, they came up with certain tests for whether you treat it as a capital lease or not. And as you apply these tests, you'll see that, you know, it really looks more like a purchase. So if there's a low buyout cost at the end of the lease, we're going to lean towards capitalizing it. If the life of the asset is longer than the lease term, like an airplane is 20, 25 years, but you're leasing it for a 10-year period, you're likely going to take advantage of that low buyout cost and still use the asset for, you know, 15 years after the end of the lease. If the total of the lease payments is close to the purchase price, it smells more like a purchase. So we're going to force you to capitalize it. And finally, the reasonable person test. If a reasonable person would always, if you've leased the plane for 10 years and you can buy it out for $100, any reasonable person is going to exercise that ownership option. So all of those are factors they would look at to determine whether you're going to have to capitalize it and take capital cost allowance on your tax returns.
I'd like to just take a minute. I think there was a little bit of accountanese in there that probably needs to be explained. There's this concept in accounting, and well, I mean, it's a real economic concept, that $1 today is worth more than $1 tomorrow. Not only because of inflation, but the bird in hand versus two in the bush kind of idea as well. So as time goes by, when you're doing these calculations, you have to adjust the future payments for the decrease in the real value of the dollar, the spending dollar. So I don't know if I've just helped explain that or made things more confusing, but when we're talking about present value, we're talking about taking all those future payments and bringing them to a dollar term in today's dollar to help you make that decision. So if we're talking about future value, that could be like the price that you pay down the road, for instance. I'm sure there's probably some questions about that. Please, by all means, start up in the chat if there's any questions. We're going to be getting a lot into this concept in the next few slides.
Yeah, we'll see it in the examples.
Sorry for interrupting, Bob, but I wanted to make sure that was explained, the time value of money concept.
Yep, yeah. So the factors that you likely want to consider when you're looking at the buy versus lease equation, you're going to look at the unique cash flow needs of your business. Is your business throwing off significant cash so it can afford to purchase the asset up front? And if it's not, if you're making a steady stream but not a huge amount of cash flow each year, then you're going to lean towards leasing. The credit worthiness or a business's ability to obtain financing. If you purchase something, you've got a mortgage against it, but the person who's giving you the mortgage doesn't really want to exercise it and take over the asset. So if you don't have good credit, they're likely not going to give you financing on it. So you're going to lean towards leasing. They also check your credit in a lease equation, but it's usually an easier process to get approval. The lease company can come in a very short period and strip out the asset if you're not keeping up to date with the payments. Another good factor is the need for new technology. If technology is really moving quickly, then you're going to want the flexibility of a lease, likely, because you keep it for, and you can tailor your lease terms to the expected renewal period of the asset. So if you're working with something where the technology changes in 3 years, you can tell a lease company, I want to lease this over a 3-year period, not 5 or 7. And then the tax incentives, we always bring the tax factor into our analysis. So on the purchase side, you get to claim capital cost allowance. On the lease side, you get to claim your full lease payments. And then just understanding your business, understanding where you are in the business cycle, having a projection of what your future may look like and how financially stable you are currently. And then, of course, the topic we just discussed, being aware of the difference between a capital lease versus an operating lease. So just to step back and look at all those factors at once, I don't know if you picked it up, but if a company is, if it's a new business and it doesn't have a lot of background, its revenues are up and down from year to year, they are strongly going to lean towards leasing. So that's the type of company that if you're involved in, you will normally find that not the financial analysis necessarily, but just understanding where your business is in terms of its history and development. If it's relatively new, you can likely lean towards leasing if you're advising someone. If you've got a larger company, it's been in business for quite a number of years, its cash flow is pretty stable, then you will likely lean towards the buy equation. You're like, especially with real estate, you're thinking about that capital appreciation. The company has built up a nest egg, it's building its equity. So, and it can get a bank loan or a mortgage on the property. So you will find more mature businesses with more stability will lean towards purchasing. But the mature businesses will, depending on the type of equipment, they certainly do a lot of leasing, like all the computer equipment in their offices. They may lease automobiles for their management staff. So they will still look seriously at leasing. They don't want to own those automobiles and have to maintain them. Excuse me. They just want to be able to drive down the street and to the lease company where maybe they have a mechanic shop and they take care of the oil changes and all of that. So leasing is still in the equation in a mature company.
One of the areas where we find quite often there's a deficiency in the records of businesses are in the supporting documentations for either the purchase and the financing or in the lease. Quite often it's a document that we have to request. Sometimes there is no loan or amortization schedule, things like that. And this is something to consider that the accountants really should be asking for come tax time. They should be asking for the supporting documentation for the lease or the purchase or the financing. So that's something that you could prepare ahead of time as well. Okay, big ugly example using the future time, was it time value of money concept to show the present value of cash flows. Bob, your example, I'm gonna let you run with this one.
Oh, come on. You're the management accounting trainee.
Well, I mean, happy to do it, but
no. So this example, we're going to look at first an equipment purchase calculation, and then in the next slide we're going to look at the equipment lease. Now this I didn't lay out all the background details. I didn't want to go through all that. I just wanted to show you the type of analysis that will fall out if you're looking at analyzing or comparing a purchase versus a lease. So you can see if there's a purchase, you've got your cash payments from year 1 through 5. And in both of these examples, we're going to dispose of the asset in year 9. So you have to make sure your assumptions, both on the purchase and the lease side, are consistent with each other. You always want to be comparing apples with apples. So you want to start the company or start with an equal position in both analyses, and you want to end with an equal position where you've disposed of the asset, or in the lease example, you will have returned the leased assets back to the lessor. So because the lease is assumed to be, I think, 8 years long, we are assuming that in year 9, we dispose of this asset. And at the end of year 9, it's worth $2,500. So we're going to make our mortgage payments or our loan payments from years 1 through 5. And basically going across this sheet, what we're aiming to do is get to column F. So you want to look at your net cash outflow year by year by year. So you can see for the 9 years, the net cash outflow is captured in column F. We'll talk about G and H in a couple of minutes. So to get to your net cash outflow, if you're purchasing this equipment, you've got a down payment of $12,500, and there are no tax savings in the first year because you're not filing your tax returns until the following year when you get to claim some depreciation. So in the first year, basically, you've just got your cash outflow. We make a down payment, $12,500. And then we're going to start paying down the loans. So we pay $11,830, and we take some depreciation, and we have tax saving of $4,000, which is 40% tax rate. So our net cash outflow is the net of those two. The next year, we keep making the same payment. And now, after the first year, we start paying some interest. So that's where the amortization schedule that Jonathan talked about comes into play. And at first, a question I had was, why is this the prior year's interest and the prior year's depreciation, so everything slips a year? And I finally figured out the reason for that is because you don't get to claim those things until you file your tax return, and you don't do that until the next year. So everything, if you're looking at tax numbers, everything slips a year. So in year 3, you're able to deduct some interest, you're able to claim a full year of depreciation, and that gives you the amount of your tax savings. Then, so your net cash outflow is the difference between the cash payments and your tax savings. You've reduced your taxes by $7,900. So we go through that analysis year by year. We finished our payments at the end of year 5, so we no longer have that cash outlay. So basically, what the residual we have is tax savings. So our cash flow analysis actually turns positive at this point. And this is a typical thing that happens when you're doing a buy versus lease. If you think of a lease, your payments don't decrease. They're pretty level over the full number of years that you're leasing the equipment. But this demonstrates that on the purchase side, you have heavy cash outlay initially in the early years, and much lower and maybe a cash inflow in later years. So the purchase equation tends to be very negative if you only look at a couple of years, but it quickly turns positive. We'll talk a little more about this when we're looking at the real estate example that we're going to end this session with. So there you are, where we've explained up to column F. In the final year, the equipment has a residual value of $2,500. We sell it, and who knows what doesn't matter what we choose to do at that point, because that is going to put us in exactly the same position that the lease analysis is, where we just, the lessor comes in and takes out the equipment because the lease is over. So you're going to have to pay taxes on that capital gain because you've written off the equipment. So you actually have you still have savings because you have the net proceeds of $2,500 minus the tax you pay on that. So you end up in column F with the net cash outflow. Now we get into the net present value calculation, which Jonathan mentioned. So what this is $1 down the road is worth less. What we have to do for both the lease and the purchase example, we need to bring everything back to what are these dollar values right today. If we were to, if these numbers were totally accurate over the 9 years, then in the second year, column F is 7,830. That 7,830 has a lower value today than it does a year from now when we pay it out. So we do a present value calculation. And actually, we're using something called a discount factor, 6% and cost of capital. And Jonathan, maybe we have to do a session on cost of capital and how you calculate that. But that's a number that is unique to each business, depending how they're financed and funded and so on. So just accept that that number will fall out for any given business. So we use a 6% cost of capital, and we end up with present valuing the 7,830. Its present value is 7,387. So now I haven't done this, but if you want to check that calculation, take the 7,387, grab your calculator, and multiply it by 1.06. And if things are working out and I'm right, it should come out to $7,830. I haven't actually done it, but that's how a discount factor works. It's if you spent $7,387 today, it would be equivalent at a 6% cost of capital to $7,830 a year from now. So when you go into the second year, you can see that the discount factor shaves even more off the 3,930. So that is worth even less today because now you've got 2 years at 6% cost of capital. 3,498 times 1.06 times 1.06. So you go along with the annual cash flows, excuse me, continuously discounting them for 1 additional year each year. So like in the last year, the $1,500 inflow actually discounts after 9 years to $941. $1,500 at a discount rate of 6% is only worth $941 today. So the net proceeds of selling that equipment after 9 years is much lower than the amount you're going to receive in the future. So the final step, once you've discounted all the annual cash flows, is in column H. So you've got the annual numbers, and you just add all that up. So we would say the present value of purchasing this equipment is $32,204. That's our total present value cash outlay with tax considerations included, $32,204. Now let's skip to the next slide, which is the lease equation. And if you just go down to the bottom, you'll see the present value of leasing is $34,838, like almost $3,000 higher. So purchasing the equipment puts $3,000 extra in our pocket versus leasing it. So to go through the lease example, and we can do this pretty quickly. I think it's reasonably straightforward. So you've got your 8 years of lease payments and your tax savings delayed by 1 year. And basically that's it. That's your net cash outflow. Yes, that's your cash outflow. Prior year's tax savings on the $8,500 at a 40% tax rate is $3,400. So we use the same discounting factor year by year. You'll see those discount rates in column E are the same as they were for the purchase example, but the cash outflows that we're applying them to are, of course, different. So in column F, after we've done our discounting, calculate our cash flow, we get the present value year by year of leasing, and it comes to the $34,838. So this is the type of analysis you would lay out for your client and say, if you have the money to make that higher upfront payment and to pay it out after 5 years, instead of spreading your smaller payments over 8 years, then it's to your advantage by $3,000 to buy the equipment today instead of leasing it. I don't know if there are any questions, or that's a pretty summarized view of what the analysis would look like. And it does get, you have to think about a lot of the factors that go in. And if we'll start talking about real estate now, because that's a whole new ballgame. It's the real estate analysis is one that gets takes into account many more factors and is quite a bit more complex than equipment. Jonathan, did you want to add anything, or?
Not at this time. One thing I was going to say is these things can get very challenging, and we're here to help. So if you have questions as to whether or not your customer has capital lease versus operating lease, or if you need some help making these kind of analyses, by all means reach out to us. We'll be happy to help.
Yeah.
Do you want to take away the commercial real estate example?
Sure. I think we have just time to go through it. So thinking about real estate, there should be much more thought put into this. Real estate is generally a much higher dollar value than equipment that you might lease. And of course, real estate lasts for a long time. So it's not just a 5-year or an 8-year lease. You're going to be pretty much stuck with this decision for a significant number of years. You need, for real estate, because there's flexibility, like a lease for equipment is a fixed term. You're doing an 8-year lease, so your analysis is going to be for 8 years. On real estate, if you use a different number of years to do your analysis, the numbers are going to change. And because you can, if you lease office space, you can always renew your lease, and you likely would be doing that a lot of the time. So you can choose to end the lease or release it. So that you have flexibility in how long you want to do the analysis for. And the key is you should do it for different number of years. It's typical to do it every 5 years. Do it for 5 years, 10 years, 15 years, and 20 years. And what you're going to find is that in the short run, because of the high upfront costs of buying is going to seem less favorable than leasing. Like if you do a 5-year analysis, almost always you will want to lease. But real estate is really a much longer term asset. So this is where, when we were looking at the factors you'll consider in whether you buy or lease, this is why you really have to think of the length of time you're going to be using this asset. So, and I run across this a lot, so I'm just putting it in here as a rule of thumb. A lot of times the 7th year, around 7 years, is a crossover point when you're looking at owning versus leasing. So leasing, if you do your analysis for 7 years or less, leasing will look like a better deal for you. But if you go out beyond that, the longer term, purchasing will normally be a better deal. Part of that is due to the capital appreciation. Your building, your real estate is going to appreciate presumably every year. We usually make that assumption that, there's growth in the value of, and then you relate it to an inflation factor, but 2 or 3% a year is not uncommon. And so you'll bake that into your calculations. So of course, the longer out you run your analysis, the more value you're going to get at the end of the purchase equation. And that's going to make buying seem more attractive the further out you go. You have to consider your space needs into the future. Are you going to outgrow it? Do you want to deal with the hassle of maintaining a property? So if you own the property, someone's going to have to take care of the air conditioning and the parking lot where somehow you've had a plumbing leak and it's washed out half your parking lot and it's sunk by 4 feet. The air conditioning inside, maybe your security alarms go off in the middle of the night and you've got to have someone available to go in and check it out. By the way, these are all real life examples that I've run across where people had to get up in the middle of the night and take care of things. And so it is a hassle. If you're in lease space, the owner takes care of all that. Can you afford to tie up your capital by purchasing commercial real estate? And do you want flexibility or stability? And then you're likely going to want to involve a commercial real estate broker in the analysis. They will help you out with a lot of the assumptions you're going to need to build into your analysis. How much should we expect this to appreciate? What are the lease rates? What kind of a lease are we going to get? Usually when you do a lease on real estate, you get some incentives up front from the lessor to entice you to take over the lease, to do the lease. So there can be a lot of complications built into, and a lot of assumptions built into the analysis. And the other thing I will say is for real estate, thinking about those assumptions, what you'll want to do is build them into your analysis so you can change them. Like, what if buildings escalate at 5% a year? We're in a time when real estate is really moving ahead. So we want to change that assumption and just run a little sensitivity to see what impact the value of the building increasing at a different rate. What if inflation kicks up? What if leased premises are somehow everybody's moving into the area, driving up lease rates? So you'll want to run a number of you should want to run a number of sensitivities to show how much do these results change based on changing different factors. Which factors are more critical in terms of making our decision? And I do have to give a shout out. I stole this example from a place called Fitz Small Business. So I just wanted, if you want to go to that website, you will find much more detail on real estate. The one qualification, when I went through the numbers, and I know I didn't spend hours on this, but I didn't see where they were doing those net present value calculations, which definitely do need to be included. So maybe they're there and I just missed them, but we do need to net present value on both the lease side and the purchase side. So just remember, you'll have to bake that into your analysis.
There's just one more thing I want to talk about with regards to local trends. So there is also a risk to leasing. Currently in Toronto, in the GTA, and this is expanded beyond the borders of actual Toronto, there's situations where when the lease comes up for renewal, the lease amount is being jacked way up. It could be for a variety of reasons. It could be to catch up to market value. Commercial leases are not governed by the Landlord-Tenant Act. If you have a lease renewal coming in, you can always increase your lease payments that you're demanding. It could be to encourage people to vacate so the property can be developed, or for any other kind of reason. And I've seen recently, in the last 2 years, a couple of situations where businesses have invested a significant amount of money in later stage leasehold improvements. So, like, let's say they're on a 5-year lease, and in year 4, they're investing a significant amount into leasehold improvements, and then when the lease renewal comes around, it's being jacked way up and becoming unaffordable to stay in that space. So these are risks that also need to be considered depending on your local market as well. I just want to make sure that people were aware of that.
Yeah. Tanya, I see someone has put in the chat that they have to leave in like 3 minutes, and they're wondering if we can do the second survey now, the second poll question.
Sure. Yeah.
I think we could skip to it because certainly they have attended the full session. So we'll do our poll now and then continue with the real estate example.
Okay, perfect. So I'm launching.
So the question is, have you ever done a buy versus lease analysis? And that means outside the classroom, in real life. So we're interested in how many times people have done this, or whether you've ever done this for a client, friend.
Okay, so we've got 12 out of 13. Just waiting for one more person. So we'll give them another 15 seconds and then we'll close it up. I don't know if they're paying attention or not.
Somebody's
All
not going to
right.
get their credits.
Well, we only had 11. It was interesting. We only had 11 the first time. So there's only still a max of 11. Hopefully it's the same 11. All right, so that's okay. We'll get the polling ended and I will just share the results. And there we go. And I'm a no as well too.
Okay.
If anybody's interested.
Well,
So
please
only one yes.
don't, as Jonathan said, don't hesitate. If you've got a client doing this, come and talk to us and we can go through it together, work with you and your client, and add some value to what they're doing.
And it's interesting because whenever clients have called me and asked me, I've just said to them it really depends on their cash flow, because at the end of the day, it really shouldn't make too much of a difference. But obviously, we're seeing in these scenarios that it certainly can.
Yes. Yeah. Wait till you see the results of the real estate example.
Yeah. Well, now, of course, that
Real
absolutely
estate
would be, big difference. I could imagine that. But, if somebody wants anything more than just, hey, here's what I think, but definitely I've always deferred to the accountant, really.
Yes.
So, yeah.
All right.
Yeah.
Shall we go back to the real estate example?
Yep. Perfect.
Sure.
All right.
And our time is almost up. Okay, so this is really, really summarized. We could spend a half a day going through the details of just this one example. So the factors you are going to consider on both the lease side and the purchase side are listed down the left-hand side. So you're going to have some upfront costs. You're going to have your annual recurring costs, and you're going to have your tax savings. Calculate those the same as we did in the equipment example. You're going to have, if you purchased it, you're going to have the earnings on the sale of the property, and then you're going to have an opportunity cost. So as you sink cash into either of these approaches, you're using cash. So depending on how much cash you use, there's an opportunity cost, because you could have taken that cash and invested it. So if you think of comparing two examples, if on one side you burn through $10,000 over 15 years, and on the other side you burn through $1 million, that really impacts your comparison of the two. So on the $1 million side, you're going to want to penalize that because it costs you a whole bunch more cash. So the way we measure that is by looking at the cash flow each year, looking at the lost interest that we could have earned, and then net year by year by year, net present valuing that. So you'll see, and this makes sense to me, the opportunity cost for leasing, because you're burning through a higher amount of cash, the opportunity cost is higher than on the purchase side, where you have a lot of upfront outlay of cash, but you catch up to that over time. So I won't go into how all these numbers are made up. If you actually go to the example, they have all the gory details there. But I just wanted to present for real estate the different factors that you would consider. So this is a 15-year analysis that they've done, which is pretty typical for a long-lived asset like real estate. And you can see that the net present value, if they had done it, I'm not sure they did. So leasing is going to have a cost of $711,000 for you. Purchasing is going to have $400,000. That's a over $300,000 difference you make up if you own versus if you lease. So that's pretty material, I would think, to most clients. And if you can lay out numbers like this to them, they may think twice about, oh, I'm just going to lease my property because I don't have the money right now. I could probably get it and purchase the building, but leasing just seems like a quicker, lower cost. But if you look over time, buying is going to create a significant balance that will only grow the more years you include in your analysis.
So I believe that pretty much brings us to the end, right? And
I think so. And the end of our time.
Definitely the end of our time. Are there any questions, comments, stories, why bother, different ideas like that?
I could tell a story, but I see we're over our hour, so I'll defer.
Well, Maria, I'm glad you got something out of this.
Yeah.
It's a quiet group out there today.
It is. It is. This kind of example can also be used to determine how long you want to lease for, how long you want to finance a purchase for, different things like that to determine, how much the cash flow should be, things like that. And of course, what is the better term? No questions. Okay.
I think maybe a lot of people are a little intimidated by an analysis like this, and probably may not want to get into it. I know the last one I did, it was a little intimidating at the start for me, and but when I got into it, when you go through it, it all starts to make sense. But you have to do it once or twice to become comfortable.
Makes sense.
Okay.
I guess the challenge is to people, if you see one of your clients in a situation like this, give it a shot. Like if you can present a client, if they're thinking of buying a building, and you can show them that over a 15-year period, they're going to be $300,000 to $400,000 better off by buying than leasing. Don't you think that's providing some value to your client?
Absolutely.
Just a little.
So.
Thanks for your comment, Lori. I'm glad that you found it easy to understand.
And maybe that's why there's some questions. I found it very easy to understand.
Okay, good.
Good. Yeah. Well, I have a simple mind, so it.
Sure, Bob. Sure.
So.
Well, thanks, everybody.
Pleasure to present. We're taking a break for the summer. We'll see everybody back fresh and excited in September. And thanks. Really appreciate your attendance today.
All right. Thanks, everybody. Take care. Bye.
Bye.